My next guest is concerned about the banks for the same reason Charlie Munger is. It's their exposure to commercial real estate. Roughly $1.5 trillion of CRE debt will likely have to be refinanced at higher rates in the next 18 months, unless rates collapse by then. Despite that, he still sees the Fed hiking tomorrow. Sounds like Steve's panel. Let's bring in Randy Kroszner, a former Federal Reserve governor and economics professor at the University of Chicago Booth School of Business. Randy, thanks for your time today. And, I guess I have to ask you first and foremost about FDIC deposit insurance here, not because you're an expert per se, but because that might be the only solution. For instance, your former colleague Eric Rosengren just tweeted, deposit insurance ceilings need to be raised or eliminated. The steady attack on regional banks is destructive to financial markets and ultimately the economy. Is he right?
Well, I certainly agree with the latter part that it is disruptive. I think we need to rethink the entire bank funding model. We used to think that, basically, in the response to the global financial crisis, we said, we don't want banks to be funding themselves through borrowing in the markets. We want that steady source of funding, deposits. Now we know that they're not so steady as they once were. Deposit insurance is fine up to its limit. We have firms holding very large payroll balances in some of these banks. They, unsurprisingly, have gotten skittish and are moving to some of the larger banks. So I think we need a broader rethink about how banks are funding themselves.
Yeah, and by the way, he's not the only one. So Bill Ackman, Steve, I don't know if you saw this tweet as well, saying that after the Fed hikes, as they're expected, we start to see, for instance, a lot of those money market mutual funds offer 5%. He says, you think we're not going to have a renewed round of here's the Ackman tweet, of deposits leaving the banking system and going elsewhere?
I mean, that's really been the story. Look, I'm ready to tell the positive story on regional banks. Frankly, I was unconvinced by Chris Davis, who said that there's a low cost there at 1%. I don't think that low cost remains. As Randy just said, Randy's a former banker. He should be out there supporting the regional banks, but he can't do it because it's very difficult, Kelly, to say the regional bank deposit base is safe. There is one ace in the hole they have, which is that.
But did they already play it? The ace in the hole was J.P. Morgan,
That's one ace in the hole.
And they already played it.
I'm saying in terms of the longer-term business model. The longer-term business model ace in the hole is, in order to lend locally, they have to be located there, and that's it. But I don't know that the deposits have to be there locally. That's really the problem that we're having trouble is joining and understanding the connection between both sides of the balance sheet.
And Randy, undoubtedly we know that this is going to impact the macro economy. I mean, it seems ludicrous for them to hike rates tomorrow. Am I wrong?
Well, I think it's going to be a real nail biter because I think you've got two views around the table. One is that there are banking and financial problems. We use macroprudential policy to deal with that. And we've got an inflation problem. We've got to go head on in that. Others are saying they're intimately related. And so if we raise rates, that's going to be problematic. It's going to be very interesting when the transcripts come out in 5 years from now. So I think they were clearly going to this meeting expecting to raise rates. And I'm not so sure they're going to do that. If they do, they're going to make it really clear that they are sensitive to the issues that are happening right now and that they're not going to be going forward, Randy, with more rates.
Let's do the transcript now, okay? I'm at the meeting. Hey, look here, Jay. I got the KBW down, whatever it is down today. How many?
7.5%.
7.5% today. Look at what happened to the January Fed funds rate. It fell by 20 basis points today.
Wow.
It's ridiculous. I don't know if they have that chart in the back.
What are we down to, roughly?
It's 440. So the gap between where the Fed thinks it's going to be and where the market thinks it's going to be has widened. Look at that. 440,
and just so people
exactly
know what this means, that means by January.
Well, by December. I mean, that's why we use January,
6
right?
months away, let's say 7 months away.
Right.
They think the funds rate, which they're going to raise above 5.5% tomorrow,
today,
will be down
and
to
stay
4.4%.
Right, exactly. So Randy, how does that play at the table there? Does somebody come forward and say, hey, you know what? Is this something that should cause us to pause? Or somebody else comes forward and says, you know what? We're not going to be messed around by today's gyrations in the market.
Exactly. So they're going to be the people who say we need to move ahead. The big picture problem is inflation. And if we just respond to market movements, we're just going to be pushed around and we're not going to solve the problem because they're going to go back to what happened in the late 70s, early 80s when the Fed paused too soon. And that's when Volcker had to raise rates to double-digit levels. Remember, the last time inflation was this high in the U.S., we had interest rates at double-digit levels. Mortgages were at 12 or 14% if you could get one. We don't want to get there. And so that's going to be the argument of why they need to move. ultimately, 25 basis points one way or another is not going to make or break the U.S. economy. If it does, we're in such a difficult situation that that's a problem.